Okay, welcome everyone. We'll start our second lesson in which we'll cover LO2. LO2 is our learning outcome to be able to calculate taxable income, corporation tax, and prepare corporation tax return. So today really will be focused on taxable income, corporation tax, and how we can prepare the tax return for corporation tax and itself income tax as well. So before starting our lesson, we'll recap what we learned during our last lesson and what we're supposed to cover today lesson. So anything you remember last lesson, what we learned, please?
So what I learned last lesson was basically be able to calculate tax for the self-employed and complete self-assessment tax returns. And furthermore, I learned most of plant and machinery capital allowance computation and next topic was basis assessment for employment income using the how much our employee's salary used to compute your tax. Then next one, yeah, capital and revenue expenditure. What is the difference between both? Then what are tax avoidance and tax evasion? What difference? And
Which one is illegal? Which one is not illegal? Tax avoidance is illegal, or
tax avoidance is legal, while tax evasion is a crime because you're trying to hide money.
Yes, well done, great. Okay, yes, great. So we learn about personal allowance, how we can deduct personal allowance from the tax year, how we can transfer the losses, carry forward or back forward if we have a tax liability. So we can make adjustments, all we discuss. And we discuss a professional code of ethics if as a accountant, as a tax return, as a tax advisor, we're supposed to be follow those professional code of ethics. We discuss about 5 professional code of ethics. Normally we to keep remember this word, we use the word is called popular people chat in offices. So first P is stand for professional behavior, second P is stand for professionally competence and due care, it's mean up to date knowledge. Third, we discuss about confidentiality, we keep the things confidential. Fourth, we discuss about integrity, mean honesty, and the fifth, we discuss about objectivity. So all these professional code of ethics we're supposed to be follow when we deal with the tax. We can't really hide it. This year income we'll put in the next year. We should record accrual or matching concept we learn in accounting. So we should record income and expenditures when it's belong to the year. Okay, that's all we discussed during last lesson. So today lesson we'll move forward and we'll discuss today LO2, be able to calculate taxable income, corporation tax, and prepare corporation tax return. Today lesson we'll discuss the tax laws and implication uncorporated and corporated business. So what is the difference between uncorporated and incorporated business? What do we know anything about incorporated and corporated business? What is meant by incorporation?
No, I don't have any idea.
So corporate business is meant by the company is registered like as a public limited, private limited, we call corporations, yes?
Yeah.
Other is a sole trader and partnership unincorporated business, yes? They're not registered, so they can be unlimited liability. So it's good to be determined is a corporate business, uncorporate business, because in case of not paying it, it can be personal liability. Yes, it can be unlimited liability, but in case of corporate business, we can't claim or we can't charge to the individuals. Yes, we're supposed to charge to the organization. Corporation is artificial person. Okay, so then we have a second assessment criteria 2.2, determine from the given data tax payable and the chargeable gain. We can calculate from the data. We have picked some data which we'll go through. Calculate the adjusted profit. Yes, we can make adjustments and we can calculate the profit, and then calculate the corporation tax liability from the given data, and then 2M1 is which is a merit, demonstrate how prepare the plant and machinery capital allowance. Yes, I copied some links which we can go through as well. Capital allowance. So all this will be these things will be focused in our lesson. So I copied the inductive contents what we're supposed to learn. In define the term of period accounts and accounting period and financial year. Do we know what is the difference?
Accounting period is the time when the business commences, like April 1st, and end of the year, that is March 31st. That's the accounting period.
And financial year?
Financial year is, I think it's to do with the finances in quarterly amount, like half year, full year.
If I'm right, in India is July, 1st July start our financial year there, yes?
Yeah.
And in a finish 30th June. In UK it start 1st April, it finish 31st March following year. So that is called financial year, and the tax rate is falls in those years. Allowance we can claim in those years. Yes.
Yeah.
Okay. Then we have a taxable total profit. What is the profit? Those are the taxable profit, because the profit is a different thing. I can, like last lesson we discussed about depreciation. It's not allowable expense for the tax purposes. We have to add it back. Yes.
Yeah.
And augmented profit. Do we know what is meant by?
Augmented profit. I've come across the term, but I still have not a clear idea what is it.
Yes, it's all about, after the adjusted profit, yes. For the tax purposes, we need to make some adjustment, yes. Then we can charge the tax on it.
So this is profit after interest and tax.
Yes, the profit which is chargeable on tax purposes, which we'll go through in the next slide as well, further in detail. And do we know the residency? What is meant by resident?
Residency is basically a place where a person stays, or in this case, company residency is where a company's residency is like where they work in like where the premises basically.
Yes, so is a resident mean they do the operation in those countries. So if they have a head office there, so they have a local so they have to be applied the both countries rules and regulations. Yes. So resident mean if you living in a country 90 days, yes, you become a resident. And if you stay 160 days in that country, tax rules apply to you. So if you're not living in the UK, you're working only 1 month, 30 days, you're not a resident really for this country. So fully tax rules not apply to you.
Okay.
Some people come, they do the live music concert, only 30 days work in this country, 30 days other country. So different countries, so maybe they're not paying any tax in it. Yes, they maybe not fall in the limit, yes. And they're not a resident. And like if even you're a national, if you stay abroad, you're not it's called NRI, like in India, non-resident, yes, Indian.
NRI, I think, for India.
Yes, NRI. So normally they use in movies, terminologies are normally used for the tax purposes as well, yes.
Yeah.
So that's we can. Expenditure allowable in the calculating trading profit, yes. What are the expenditure? Those are allowable. So which we will discuss. Plant and machinery, we can claim the capital allowance. We can't claim the depreciation. Last lesson we discussed, yes.
Yeah.
Property income, yes, we have to pay tax on the property income is a different rates we discussed last lesson. Yes, if we have any revenue expense like we're doing cleaning, painting, coloring on the properties, we can claim that. Relief on the property losses, if we have a loss on, we can claim the relief on it. Yes, that will reduce our bills. Interest under the loan relationship rules, we need to look around the interest. Yes, if we'll give interest to somebody, if we'll give money, borrowing money, and we should charge the interest can be again. Yes, and other interest we will pay. All these rules we have to follow. Chargeable gain. Gain is mean you have a property, you have a jewelry, you bought it £100, no, is worth of £10,000. So on the gain, when you dispose of, you have to pay the capital gain tax.
Yeah.
And if you revalue your asset, you have to pay the capital gain tax as well. Chargeable qualified charities payments, yes, those are qualified, those are exempt. We need to be the registered charity, they work within a country. Yes, those all, and they do the activities welfare. Trading losses, we discuss, we can move forward and carry forward, and they calculate corporation tax, which will go through dividend. We know the dividend, yes.
Yeah, dividend is it's something which is paid back to the shareholders.
Yes, brilliant. And do we know the marginal relief?
Uh, no, I don't have any idea about it.
Yes, there is a formula to calculate, and relief mean reduce your tax bill. Yes, give relief. So companies are
Okay.
entitled marginal relief, huh?
Okay.
So, and the penalties, we discussed different penalties can be, yes, all, the tax. So I included all the rates and the penalties. Yes, last lesson we discussed as well. So next our focus will be is some accounting period. What is meant by accounting period? Accounting period is a period, yes, which is make the corporation tax, usually 12 months. Yes, same as the company period of account. Can be less than 12 months, can't be more than 12 months. Yes, first
Yeah.
year can make the account for less than 12 months. Yes,
Okay.
maybe we'll start 1st July until 31st March, so we can prepare the account for this, and the next year will be whole year accounts.
Okay.
And then, of course, we know the financial year is falls in which is the tax rate applies. And the HMRC, of course, we know, yes, the HMRC is a taxpayer in other countries, CBR, Central Board of Revenue, and or maybe in other countries can be different names, yes. Accounting period, which we discuss, usually 12 months, all this. And then next we looking 2.1. 2.1 are assessment criteria. We need to look around tax laws and its implication, uncorporated and incorporated business. So uncorporated business or corporation is a separate entity from the business owner and has the natural rights. So a business owner and the unincorporated business are the same, and the owner personally be all the result of the business. Yes,
Yeah.
unincorporated business are usually sole trader and partnership, and incorporated business is from the liability they might incur from the running business firm, and incorporated business does not. Yes.
Yeah.
So that's all about. Sam, it's true with the lawsuits against the business. It's not against the individuals. Yes. If you are corporated, if you're uncorporated, it can be against the individual. Any
Okay.
question?
It's an incorporated business protects owners from liability which they may incur. So this basically means if the business has a debt, the payment for the debt has to come from investment in the business. So that is the payment has to come from the business operations.
Just like if it's an incorporated business and don't pay the tax, that can be claim go against the business. Yes, we can say to be liable director not showing that correct information. Yes, director can be charged the individual, but they can't claim from their personal asset. Yes, because it's a limited liability business, other way around.
Okay.
like a limited company, LTD, PVT, yes, private limited, public limited, PLCs.
Okay. Understood.
And in other case, of course, if you don't pay it, you can be liable. That's the key difference. Okay, then corporation, different tax rate and deduction. Corporation pays normally lower tax rate, like Donald Trump reduced the corporation tax to 10% around. It used to be 20 to 30%. Sorry, they reduced to 18% instead of 32%. So left a
Okay.
business person. So what will be happen? So most of the company, instead of going abroad, because like one of big pharmaceutical company, I think so. It start. It's not coming, recalling the name exactly. So, but that pharmaceutical company was thinking to be, if they have around $10 billion turnover. So they're supposed to be moved to Ireland because in Ireland head office. So it's in the previously the rule is that where your head office is based, that country tax rule will apply to you. So that's why but they decided after this, they will stay in America instead of moving. So a lot of jobs cut can be happen. So that's why they just want to be look around the rates, different rates and deductions can be cost to incorporated and operate business. If you are incorporate, you have maybe incur more cost because you have to submit your tax return and the reports, financial accounts into the company house and security exchange commission as well. Yes. So is a
Yeah.
more so different rates and different costs can be applied to you. Any question?
Yeah. Ireland has much lower tax rate than UK, right?
Yes, in UK is around we have used to be 28, 29%. It's been reduced to 26, 27%. No, government is thinking further to reduce corporation tax. Yes.
Yeah.
Bec-
So because I heard that Apple has a lot of cash reserves in Ireland because of its low charge on tax. That's why.
Yes, it depends, which bracket you fall. Like last lesson we discussed about individual tax rate as well. Like, if your first 12 and a half is exempt, yes,
Yeah.
and then you have a tax, in the same way the company have a limit as well. Yes, they don't have to, and then they have to, which will go through in this lesson. We'll look, few tax rate as well. So I copied the link for you in my first slide. Yes. So if we look here,
Yeah.
so I copied this link. We can see quick, we can look around the tax rate. I'll show you. So if you look on this, these are the rates we looking. So we have a basic rate, yes, that's the last.
Yeah.
So it's carry on chaining, and then higher rates and additional rates. Yes, we discussed personal allowance 12,500. Yes.
Yeah.
Then we discuss individual. Then we have a car benefit. Yes.
Yeah.
If you're a company car you're using, and the benefit should be, we discuss Indian size. It's a lot of rules, behind. Then when charge, we discuss other kind of benefit. We not went through in detail because otherwise we're not going to finish. We discussed the contribution, yes, NI
Yeah.
contribution,
Yeah.
a capital gain tax. That's it also come under the corporation and individual as well. So which we will go through today. Inherent tax, if you have a property more than, yes, to
Yeah.
325, you have to pay the tax. Even your parents give you the gift. In the past it used to be called gift, but they changed it now. And domicile, if you stay in and you have a resident, you're national, so it's a tax rate supply. That's we a bit rates there. Further, I copied the link where all the corporation tax and as well personal tax, because we have a two tax, one is on the individual, one is on the companies. So if we look here, we can look around the corporation tax, income tax, personal tax. That's capital allowance we need to go through. So we have here yes, so we have a normal rate if your turnover is 20% now, yes. Then we have a higher rate. Then we have additional rates. Any question there?
No, this is good.
So I copied some examples as well. If you have a dividend, you have cars, you have in the next lesson I pick more corporation side. Okay, let's we'll go through now back to our lesson. Okay, so all these rates we can look around as well when we'll do some calculation. Of course, we discuss, you can include examples from, and we discuss. So 2.1 is all about the incorporated and corporated, yes? What is the key difference? What sort of, the paperwork, of course, is the difference because there's more paperwork for incorporated than non-corporated business. So next we have 2.2. 2.2 is determined from the given data, capital taxes, payable and chargeable gain. So first we need to learn about what is meant by chargeable gain. Do we know what is meant by chargeable gain?
A gain comes when a disposal of an asset has happened. If the sale of the asset is more than the carrying value, then it's a gain.
Yes, you're absolutely right. So when the chargeable disposal or the chargeable asset by chargeable person. So chargeable person is mean the resident, yes?
Yeah.
Is the criteria, and disposal other is like if you're suppose you're Indian national but you visit UK and you buy tally and you pay the GST which is we call VAT, yes.
Yeah.
So by law you're not supposed to pay it. So what you can do if you pay, because all the shops will charge you, you keep your receipt when you leave the country at airport, fill the form, and they will send you all the money because you're not supposed to pay the tax because you're not a resident of this country and the asset you are consuming in another part of the world.
Okay, so this only happens if you're a resident of UK.
Yes, so for suppose you're an Indian resident, you visit UK, you buy a tally and you're taking that tally to India, yes?
Yeah.
But you pay 20% tax on it, tally, which is a value added tax. But
Yeah.
when you go at airport, you can show your VAT receipts and you can claim money, whatever you paid it.
And they'll return it fully.
Sorry?
No, when you go to the airport and you claim the 20% VAT that you pay, you can claim it fully.
Yes, you can claim fully. What they will do, they will give you the form, yes? They will attach the receipt. Basically, that receipt, they can claim that money, what you paid it to the shopkeeper, and they can give them. Basically, it's your money, yes, because the asset you're taking abroad, you're not consuming it in UK. Yes, because the tally you will use in India, not in UK.
So if I buy a laptop in UK and I plan to use it in India, I can claim for VAT.
You can claim full VAT. A lot of people not aware of this. Every airport in UK, there is a call tax or the red point where you can go and you can give the receipts, yes, and fill the form.
Yeah. Okay.
So you can get, all. So here with chargeable person mean the resident, huh? Okay, some assets are exempt. Private motor vehicle, if you have bought it, it won't come under the corporation tax. Yes.
Yeah.
UK's government security, if you bought, their prices go up and down. You're not supposed to be pay the gain tax there. You can pay income tax, but not gain tax. Yes. And if you have chattel means like a rear assets, which is antiques, like you have a horse, you have different things. Yes, it's come under this category. Premier bond and investment, saving investments, all is exempt. Chargeable gains of the company are treated like any other income. Yes.
Yeah.
And the company is included in the corporation tax, and the company don't pay the capital gain tax. The question will be normally give the actual amount of the capital gain, but the sometime require the candidate, of course, if you're doing exam, so you have to consider it. Yes, you have to follow the rules. So then we're looking the resident test. What is a resident test? So UK resident, automatically non-UK resident test, we need to be individual in the UK, tax year less than 16 days, 46 are not UK resident any last 3 years, and 91 days work full time abroad. Yes.
Yeah.
So that is non-resident test. Previously resident in the UK in last 3 years. Yes. Consider all 5 ties. Yes. Need to be meet. Then automatic use UK resident, individually automatically UK resident if 183 days in the UK are only home in UK. If you have only home in UK, like if you're a dual national, so you're not fully tax rules apply to the UK resident. You can be, because you don't have a just UK domicile, you have a domicile of other countries as well. Any question?
UK is pretty strict about being resident in being a resident in UK.
Let's
Like
say you're an Indian national. If you live in the UK 183 days, you become a UK resident. Yes.
So if the moment you land in UK and you stay there for
Not
183
mean
days.
you're a national of UK. It means you're a resident of UK.
Okay.
Nationality is a different thing. Okay. Sufficient test. In other cases, can be you have a close family in UK, your spouse, partner, minor child, you have accommodation used in the tax year is in UK, substantial your work in the UK, days in the UK last 2 tax years is greater than 90 days. Yes, either year. And the country ties mostly time spent in UK, not previously resident in the UK any last 3 years. Sufficient ties, so still you can cluster as a UK resident.
Okay.
For the tax purpose, chargeable person, and only individual are the chargeable person, not the company. Chargeable person dispose assets. Yes, 3 elements need to be chargeable disposable asset. This include the sales, gift, and chargeable person, individual chargeable asset, and most of the asset is a chargeable but exempt, like we discussed, in the exempt list. Commutation, we can look around the proceed, we can look around the cost, we can look around the difference is a chargeable. Yes, gap. Any expense you incurred during the proceed, like you paying some expense to the company, like you hired the agency, they will sell your asset, all you can minus as well. Yes.
Yeah.
Then like a question here, this is a bit old example, but to help us, which is still we have the same rates. So here for suppose asset is a 35,000. Yes, is a land was bought in 1985 for 11,000 pounds. So 35,000 minus 11,000, so 24,000 is my capital gain. Yes.
Yeah.
So then we have a horse as well. Horse, we bought it, we sold it 22,000, but we bought it 4,000. Yes.
Yeah.
Horse are the exempt because it's come chattels. Yes.
Yeah, it's exempt.
So it won't be charged any tax on it.
Okay.
So we have a 24,000, we have to pay the tax on it. So what we said, if it's an individual, we need to be look around 12,500 is exempt, yes?
Yeah. Okay.
The remaining you have to pay the tax on it. Okay, next now we're looking now, we have here, we need to be calculate the adjusted profit for corporation tax. For the tax year 2019 and 20, Adam has a salary during the year and he made net personal pension contribution. Adam sold the antique stable and result in the chargeable gain. Yes. For the tax year 2019 and 20, B's as, so we have a three different persons. Yes. And Chester as a salary and sold the residential property and resulted capital gain there. So we can calculate this tax liabilities each individuals. So Adam's taxable income is 31,500, 44,000 less than the personal allowance, which is 12,000. Yes.
Yeah.
So
Okay.
12,500 we minus, so 31,500 is left. Yes.
Yeah.
His basic tax rate will be, so the basic tax band is extended to 43,000. Why is extended to 43,000? Okay, we need to go back to the question. Yes.
Yeah.
So his income was 44,000. Yes.
Yeah.
Salary. So 12,500 is a 12,500 is personal allowance. We minus it. Yes.
Yeah. So 31,500. Okay.
Yes. During the year he made the pension contribution. Yes.
Yeah. 4,400.
Net pension contribution. Yes. It means net after the tax. Yes.
Yeah.
So we need to make it gross. Yes.
Yeah. Okay.
So we are making gross it. And then Adam sold the antique stable. Yes. That's a chargeable gain as well. Yes.
Yeah. Okay.
So we need to add it. So what we are doing, so we looking 31,500. Yes.
Yeah.
Then we looking the basic, which was 4,400, because the 20% was deducted at source. Yes.
Yeah. So 4,400 into 100 by 80.
100
Okay.
divided by 80. Yes.
Yeah.
And plus we, yes. So his tax rate will be extended to now 37,500. Yes, basic rate.
Yeah. Okay. Okay.
Because up to 37,500 we have a 20%. Yes.
Yeah.
But now his limit will be extended because we included the pension.
Because of the pension, his basic rate tax band is extended.
Yes. So up to 43,000 he will be charged 20% now.
Okay.
So of which 11,500 is unused. Yes.
Yeah. 33,000 minus 31,000. Okay.
Yes, of course, the difference there. Any question there?
No, this is fine.
Adam chargeable gain is 9,000, 20,000 less the annual exempt limit. There is an annual limit is a 12,000. Yes, is exempt. So if you have a gain, 12,000 can be free fully within unused basic tax rate band. So the capital gain tax liability therefore is a 10% on 9,000. Yes, gain tax rate is a lower, is a 10%,
Yeah.
not
Okay.
20%. Yes.
Yeah.
So we
So
have a
for any asset or this thing, there's an annual exempt amount of 12,000.
if we have a gain is mean we bought the asset, we sold it. Yes.
Yeah.
But we not fall in the higher tax bracket. Yes. Because his basic tax rate is up to 43,000. Should be 20%. Yes.
Yeah.
So his taxable gain is, because his total gain, how much is the total gain? If we'll go back to the slides. So if we look here, Adam's total, yes, chargeable gain is a 21,000. Yes.
Yeah.
He sold it. So he sold it 21,000, but we have a rule that 12,000 can be exempt out of 20.
Okay, so 21,000 minus 12,000 is 9,000. Then you apply the tax liability percentage. So
Yes,
it's
which is
900.
we are calculating only on capital gain tax,
Yeah.
which is 10% on 9,000. Yes,
Okay.
only will be on the 9,000 will be charged. If he doesn't have any other income, yes, like he's not working and don't have any salary income, we can use personal allowance as well towards gain.
Okay.
So it means he's not going to pay any tax.
Okay. Understood.
And then we have exactly the same, we did some examples here in their case, yes. Then the B's and the Chester, different rates, yes. We need to look around the capital gain, so how much they have. So please, just a matter of, I copied the link. There are a lot of example about the capital gain. So what we can copy this link to further, because within, our time is very difficult to go all bit and pieces, but is matter of interest, because even we do one example, we can meet the criteria, but to enhance our understanding, we can copy the link, and this is all about capital gain tax. So what we can do, we can go through the capital gain tax rates, and we've been given here, yes, employment income and gain, capital gain tax, all, yes, like if we have a car fuel is again examples there as well, a lot of examples.
Yeah. Okay.
Personal pension contributions when increased, anything you specific not get it, please you can just refer me to that, yes, example, and I can go through with you.
Okay. Thank you. Yeah.
Okay, next now we back to our slides. Okay, then of course we have a property income. Property income is a chargeable income, yes, for the tax year when we earn it. So we need to look around the property income, which year we have, how much we have, if and the same way in the dividend, yes. Normally dividend is being at source, when they company issue the dividend, they deduct 10% tax on it. Yes, they don't know how much is it we fall in the basic tax rate or we fall in the higher tax rate. They straightforward deduct 10% tax on it. What we can do, we can add it back, yes.
Yeah.
Augmented profit, this figure is determine the rate of corporation tax, yes. That rate of the tax is never applied to the amount. We must always calculate, yes, augmented profit to determine the rate tax, but carefully then apply to the rates to total taxable profit, yes.
Yeah.
Any question there?
No, this is fine.
Okay, then if we have a losses, of course we can offset them as well, yes.
Okay.
Trading losses, maximum deductions, we have a rules, income, maximum deduction from the income greater of 50,000 or 25% of the total income, yes.
Yeah.
If you have a greater losses more than 50, so only you can deduct it 25%. Adjusted income, You can spread into 5 years, but you can't claim it in 1 year.
Okay.
So thus we have rules there. And then trading losses, we have a relief against the income previous 3 years. Yes. If we have a losses there or the tax liability, we can terminal the loss relief we can claim. And the next we looking calculate the corporation tax liabilities. Yes.
Yeah.
The corporation is all about is registered. Yes.
Yeah.
Can further go through what we, it's a quite mixed, because this unit is personal and the corporation, because they mention the income and the corporation as well. So Joe has a salary and saving and dividend. Yes. During the year, paid interest was qualifying purposes. Joe employee deducted on the PAY the net income, we can calculate the tax on it. Okay, like we have here, his income is, yes, saving is, dividend is, then total income, yes.
Yeah.
Interest paid we can minus because personal allowance, that was the previous year, it was 11,850 was authorized. So taxable income is, yes. And then under dividend, under saving, yes.
Yeah.
Then of course we have a rates there, 3850, we have a 20%. Then yes, on saving income, first 500 is exempt because it was 2000 saving income. So on 1500, 20% will be tax on it. Then first 2000 capital gain, yes, dividend is no tax on dividend, first 2000. Remaining, the total dividend income was 6000, so 4000 we have to pay tax on it, yes.
Yeah.
And we have to pay 32.5% because it's a higher tax band now.
Yeah. Okay. This is understood.
Okay, that's we need to, and I copied the link for you. Yes, more examples. So we'll carry on. So next now we have prepared the plant and machinery. Plant and machinery come capital asset, yes,
Yeah.
and we can entitle for capital allowance. So capital allowance computation man pool, everything not other columns. Special rate pool we can be asset, those are those falls under the special pool, are single asset pool, short life asset, those can quickly consume, yeah. Or some asset we can use for the private as well. So it can be like this type of pro forma, we can use it man pool, special pool, short life, private asset, use of asset as well. Yes, some proportion we are using private. So additional not qualifying AIA is called annual investment allowance. Yes, you're investing in asset, so we need to go through the rules. So if it's a plant machinery, maximum 200,000. Yes. If it's a less, we can claim first year full allowance there. But if it's more than that, we can't fully, we can qualify some percentage. If we disposed of the asset, on the disposal asset, we can't claim it. Yes, we need to minus it. Any question there?
No, this is fine.
This is for to address, like we have a small pool written down allowance 18%, 8%. Yes, depend upon the category of the asset. Like, first 200,000 expenditures, first 12 months, we can be exempt. Yes, apply to prorated if we bought the asset in the middle of the year. Yes, 12 months in a year, we divide 12 times by 6 if there's 6 months left. Yes, we can't claim full year. Same as all others. Yes. New car, if it's a low emission, we can claim 100% first year. Second year, we can claim only 18%. In the third year, yes, if the emission level is fall in these categories, we can claim, yes, that's the capital allowance. We can't claim the depreciation on the car, but we can claim the, it's called, yes, capital allowance. which called written down allowance. Yes.
Yeah. Okay.
Short life asset. Each asset is its own column. Is the maximum life of the asset is 8 years. Yes. Trading losses. So to address this, I copied the link. Yes. If you want to work towards marriage, so please, you can go through some questions, and I can show you 2 examples. So those will help you. So we can copy the links. So we'll upload one booklet as well for you, so you can go through. Can you see?
Not yet.
Okay, I'll show you now. Can you see now?
Now I can see.
You can see now?
Yeah.
Okay, brilliant. So that's your personal allowance. We discuss saving income. We discuss dividend. We discuss, yes. And now we have a question about companies, fuel. This is a capital allowance, huh? Annual investment allowance, yes. We've been given that we have a car, yes. 200,000, 100% we are allowed in 12 months. Any expenditure excess of 200 for the written down allowance as the normal, yes, which is the percentage applies. So only 3 months we fall in this accounting period. So we have a motor vehicle we bought, that's the level of omission level for this, and all we looking now. Man pool is 18%, yes.
Yeah.
And special pool is 8%, and then the cars is 100% if is fall this omission levels. Now we're looking now in our boxes, we've been given the example. So now we have a purchase motor vehicle, we have motor vehicle 2, we have different, yes, motor vehicle, and then we can calculate their written down allowance. So we have a man pool, yes, it falls, or is a motor vehicle special assets, yes, so we can claim it. So first year allowance is exempt up to 200,000, yes, if it's equipment. So the equipment is more than that, yes.
So you take a difference from that.
Yes, so only allowance is claimable is, yes, so rest 18, yes. So that's all their adjustments, huh? Each, so we can of course maybe we need to really go through, because it's only the rates, huh, and the rules, nothing else, and allowance as a simple percentage which we are entitled to claim. So total allowance for this year we are entitled 236.65, yes. So that's my last column is called the total allowance, yes, you're entitled it. This is a written down allowance brought forward from the previous year, yes, which we didn't claim it last year, so we can claim it this year as well.
Okay.
Okay, so that's to address and there are good few questions there, example, so that will help us to address our 2M1 assessment criteria. Any questions?
If I have any questions, then can you just email them to you?
Okay, so we'll finish here, and I'm stopping recording, and then we'll go through. Okay, thanks for attending this lesson. Please, if anyone has any question, just drop me email. My email address anjum@ukversity.co.uk, and the next lesson we'll go through LO3.